Hello and welcome to another edition of Capital Calculus. I'm your host, Anil Padmanabhan. This month, Indian companies are projected to raise over $2 billion in initial public offerings or IPOs from the market. In fact, last year, listings by India accounted for 30% of global listings. It was the single largest chunk. But this is not about just the monies being raised. They're staggering, no doubt. Instead, it is about the how and what and why of this investment. It is the story of the coming of age of the Indian retail investor. For long, they were considered risk averse, preferring security to returns. No longer. In fact, Uday Kotak, the founder of Kotak Bank, says that the Indian saver is now an investor. To unpack the phenomenon of the transforming DNA of the Indian saver, we have with us Pranav Haldea. He is the managing director of Prime Database. It is the first such database tracking primary markets. Welcome, Pranav.
Thank you. Thank you for having me.
Pranav, like I said in the intro, Indian companies are poised to raise over $2 billion in IPOs. Help us understand what is happening here. Why is this boom happening?
Well, IPOs essentially follow IPOs of the primary market essentially follows the secondary market. And if you look at the last 5 years, ever since COVID, we've sort of had a very bullish momentum, and this has resulted in the slew of IPOs that you saw even back in 2021, and now continuing in 23, 24, and even now in 2025. The reason for this is very simple. For any particular company, an IPO is a once in a lifetime event. And for them, to do an IPO, they would like conditions to be absolutely perfect, there to be bullish momentum, investor interest to be there. And which is why when, secondary markets are doing well, you will also see a lot of IPOs happening. In fact, I think the number which you alluded to in your introduction in terms of the percentage share of IPO listings, I believe that would be by volume, not by value. And that is also attributable to the SME segment that we have here in India, where you've seen a whole bunch of issues. So you're seeing both on the main board and on the SME segment a huge number of issuers coming in. So what I have been saying is that you're seeing an amazing confluence of both demand and supply. While on the demand side, of course, you've got your domestic and foreign investors, and we'll touch upon that later today. But even on the supply side, you're seeing your traditional Indian promoter-led companies, family businesses, who were initially very hesitant about giving away equity, now are all thinking about valuation and what their valuation can be after they launch an IPO. So that's a change in mindset, and which is why you're seeing a lot of companies now going forward and looking at an IPO as a integral part of their future growth plans.
I just want to pick up from where on the SME part you mentioned. So, traditionally SMEs have considered risky investments for anybody. In fact, that's one of the reasons they don't get credit. So, can we interpret from the secondary market and the primary market that there is now a growing confidence, even among the investors or whoever is buying the stock, on the inherent nature of the Indian economy and its future prospects?
Well, I think the SME segment, I always like to consider it separate from the main board. The reason is that, of course, while these are very, very small companies, um, so the nature of the companies which are coming to the SME segment is very different from the ones that you find coming to the main board now. And even on the demand side, the kind of investors that you're seeing, for the SME segment, they're primarily individuals who are investing. It could be retail investors, it could be HNI investors, but institutional participation is, so to speak, lacking there. So I have my reservations in terms of how much really what these companies really represent, and who are the investors who are really coming in. Because even after IPO, if you look at the trading volumes for a lot of these companies, they really take a dip. I always would like to, keep these SME companies as separate from the main board and not really reflective of the broader economy per se.
Interesting. So you're saying that fools go where the brave fear to tread.
It's an
So
extremely risky segment, and the liquidity is extremely shallow. So you could, if you're an investor, you could potentially be stuck after you invested in the IPO. So I always say that as far as retail investors are concerned, first of all, if you don't understand the markets, I mean, of course, mutual funds is the first port of call. Then, of course, if you want to take more risk, then you can consider the secondary market, already listed companies which are there in the main board, because there's a lot of information which has already been put out in the public domain about them. Then, if you want to take on more risk, is when you can consider the IPO, the main board IPO segment, because these are first time coming to the market. Information availability is not as much as listed companies. Price discovery is limited to the investors who are coming in at the time of IPO. And then, if you really want to take a lot of risk, is when you can look at the SME segment.
So going back to the non-SME secondary market
Yes.
and the primary market, what is the signal that it's sending across on the outlook for the economy, the Indian economy, that is?
No, I think we have been discussing this for decades, in terms of what you said earlier, that we're a nation of savers and not investors. We've been discussing for decades that the number of retail investors in the Indian market did not go up. The number of demat accounts did not go up. We've been discussing for decades, about the widening and the deepening of capital markets in India. How there were so few companies which were really, available for trading, or which institutional investors were really investing into. So I think over the last 5 years, a lot of these things have now changed, and it is truly reflective of what's happening at an economic, at a broader economic level in India as well. The kind of companies that you're now seeing coming to the main board segment, a lot of these companies, you would also find, are venture capital and private equity backed. They would have had an earlier, in fact, if I just take a step back, and you probably would recall, the 90s or even the early 2000s, a lot of companies which would come to the main board IBO segment would essentially come to raise fresh capital for greenfield projects, where probably plans were still on, even only on paper, and nothing real on the ground. Of course, what we saw was, with a lot of those companies, either the business plan did not materialize, or they ran away with investors' money. Now, that kind of initial risk capital, you're not seeing such kind of companies coming to the IPO market. That kind of initial risk capital is now being provided by angel investors, by venture capital investors, by private equity investors. There are multiple rounds of fundings that these companies are going through. Only after they reach a certain size and a scale, of course, some of them fail as well. A lot of them fail, in fact. But the companies which reach a certain size and a certain scale, they reach a certain governance standard in terms of having a board in place, audit, etc., etc. It is only then that you are seeing these companies coming to the main board segment. And I think this is something which actually is quite similar to what you find in the Western markets as well, whether it's Europe or US. Of course, one thing which is very different in India is the promoter, who's very much a significant presence, who holds significant presence in Indian companies, but there is nothing of that sort in overseas companies. But with a lot of these new age companies which are coming up, you're seeing a similar pattern now as what you find in the West. And by the time by the time they reach the IPO stage, they have a very broad based shareholding. So yeah, so on an overall basis, I think both on the supply side in terms of the companies, and on the demand side, the kind of investors who are coming in. Of course, FPIs, even in 2024, despite liquidating a significant amount from the secondary market, we saw that they invested heavily in IPOs. Uh, on the domestic side, you've obviously had the domestic institutional investors, your mutual funds, which are flush with money coming in from retail investors. Every month, 30,000 crores coming through SIPs. They've become big participants in IPOs as well. And of course, your individual investors, your retail HNI investors have been good participants as well. So I think you're seeing very healthy signs, and it's a sign of a maturing capital market ecosystem.
Pranav, so interesting. What you're saying is there has been a recalibration of the risk apportioning. Earlier, everything used to be lumped in the IPO stage. Now, most of that initial risk is taken up by VCs and other private equity groups, which means IPOs are relatively less riskier today than, say, 2 decades ago. Okay, now the quick follow-up question I have is that this is presumably signaling a pickup of the investment cycle, right? I mean, even if they may not be for greenfield projects, they may be purely for expansion of existing capacities.
Well, not really. I think we don't really need to mix this with increasing capacity or expansion from that. The reason is very simple. In IPOs, you'll find companies either which will do a completely fresh capital raise, which is the amount which is being raised is going directly to the company. You will either find a pure OFS or an offer for sale, which means that it could be the existing promoters of the company, or like I said, private equity or venture capital investors who invested in the company earlier, who are exiting at the time of IPO. And thirdly, you can have a mix of the two, a fresh capital and OFS. If I look at the last 8 to 10 years data, you typically would find that 70% of the amount which is being raised through IPOs is actually OFS, and only 30% is fresh capital. So looking at the figures, you would think that, oh, actually, not too much money is going into the companies for growth. But, the point being here that now companies are not coming coming out with an IPO to do a fresh capital. They've already reached that stage through earlier rounds of funding, which have been provided by the angels and the VCs, like I mentioned earlier. So they've already, there's no dearth of growth capital per se, and it's not that they're coming to the IPO stage to raise fresh capital, unlike what you saw in the 90s and 2000s.
Now, going to the demand side, is it this seeming democratization of investing in India, first mutual funds, but are enterprises like Grow and Zerodha and Paytm Money, are they all transforming the nature of investing in equity markets?
Well, absolutely. I think not just transforming, but they've really redefined investment into the market. I still remember the time when applying for an IPO meant signing on 20 pages on those forms, and now it's literally a matter of 3 or 4 clicks to even invest in an IPO. Of course, trading in the secondary market, FNO, has everything is on the app. In fact, I'm sure you would have seen that whether you're in the lift or in some public transport, you do find increasingly that people are on their phones and actually trading on their phones. Of course, there is an upside to this, that it's made it extremely accessible and removed the barriers to participate. But of course, there's a downside as well, as what we are seeing in the futures and options market, and the tremendous wealth destruction which has happened, especially of retail individual investors. And the flip side is that while a nation of savers is becoming a nation of investors as well, we need to be very cautious that we don't become a nation of traders who are only taking speculative gambling kind of bets during the day.
So the basic message of caution is there is no quick buck to make. You need to go in with serious analysis, and it's a stock market, so it can go up and go down. I just
Yes,
want to.
absolutely. Just if I can add one more point is, a couple of years back, SEBI had come out with the study as well, which showed that even as far as individual investors in IPOs are concerned, I think close to 75% of them exit within a week of the IPO listing, which actually shows that most individual investors come in only from a listing pop perspective. If there is a gray market premium, if there is a strong rumor that it will list at a premium, you will find demand from individual investors. And after the stock lists, they will typically exit. So it's not that they're studying the 500-page DRHP, understanding the company, understanding the industry, or looking at the board or promoters and their background. It is essentially driven by a listing gain point of view.
So, fair enough. I just want to go back to the retail investment trend. Whether you look at demat accounts or NSE unique listing, the NSE has some 11 crore unique investors, and I think demat accounts are over 12 crore. So, if not more, the my question is that is this reflecting a cultural shift, in the way Indians view risk?
Well, absolutely. I think the phenomenal rise in terms of demat accounts or in terms of mutual fund folios that you've seen in the last 5 years. In fact, if I go even further back, I think you started really seeing a trend after demonetization in 2016. That is when actually, if you look at the share of mutual funds in the domestic Indian market as well, it was at about 3-4% of the overall Indian market in terms of market capitalization. And that figure now is at about 11%. So from 2016 is when you started seeing some financialization happening on account of demonetization. And I think it's really picked up over the last 5 years. Equity is funny in the sense that it's the only asset class which sees more demand as the price goes up. So, when markets correct for a couple of months, you see a slowdown in demat account tradition. But when markets keep climbing, you'll also see a phenomenal increase in demat accounts and also in mutual fund folios. So, yes, it is definitely getting broad based. Like I said, that there is a upside to this, of course, that a lot of retail savings are getting channelized to the capital market and going towards capital formation. But there is a downside to it, which is that a lot of individuals who are looking to just make a quick buck out of it. And history has shown, and in fact even data has shown that for example, another SEBI study which came out on futures and options showed that 9 out of 10 retail investors have lost money in it. So I think that is something which we need to be extremely careful about.
So, Pranav, finally, this if we extend this changing risk behavior among the investors, we presume the same thing is happening from the side of entrepreneurs too. If you look at the startups, for example, the range of startups from deep tech to consumer to fintech, I mean, it's just mind blowing. So, are we looking at a new era for say corporate, not corporate India, but basically the private sector in India, which transcends itself because of pure uh, recalibration of the approach to risk?
Yes, I think that's a very good point, and I think what you're seeing now in India is probably what you saw in the US 30, 40 years back. And I think it's we need to take a generational point of view on this. While our previous generation mostly struggled to put food on the table, put a roof on the head. I think we were in our generation, at least these things were given, and thus with that security comes with a slightly higher risk taking attitude. And I think that is one of the key reasons why you're seeing so much entrepreneurship in India as well.
We'll stop at that. Thank you so much, Pranav, for joining us. India is at a point of inflection. The changing DNA of the Indian saver, who's now classified as an investor, tells us a story about the approach to risk in this country. It has changed for the better. Exactly what Pranav said, that this is where the United States was, say, maybe 40 years ago. So if we look at the trajectory of the United States, it only augurs well for India, especially in the context of the audacious task that it has set itself to become a developed economy by 2047. Thank you for watching. Don't forget to subscribe to StratNewsGlobal.Tech on YouTube. Hit the bell icon so that you don't miss any updates. And please to share your thoughts, ideas, and suggestions with us. I'm available on X at Capital Calculus. I'll be back next week with another episode. Till then, stay safe.